Paige, welcome to Women Investor Wednesdays.
Thank you so much, Beth. I'm really, really excited to be here. It's been a long time coming.
I am so happy you are here. So before we jump into your story, what I like to do, in case some of the audience is new, is explain why we are here and why we're doing that. Is that all right?
Absolutely.
Okay. So during COVID, I had heard a stat that of all of the investors in commercial real estate, only 3% were women. And of that 3%, half were inherited and half were women who were signing on their husband's guarantees. And I didn't believe it. I couldn't believe it. And I started asking my friends who work in commercial real estate like I do you invest? And they're like, yes. I'm like, well, where do you invest? The stock market. Wait a minute. We're in the business. This is free insider trading. Do you not invest in commercial real estate? No. Why don't you? Well, I don't have $1 million. Okay, well, you don't need $1 million. Well, it's complicated and risky. So is the stock market. And I kept drilling down, and finally they got to they got rid of the excuses, and basically it was, I don't know any other women doing it. I'm like, okay, that is a problem I can solve. So I created a virtual summit where I interviewed 8 women like you that invested in different asset classes. And they went out into these Zoom breakout rooms and talked about underwriting and raising money. It was a huge success. The 100 women that participated loved it. And since then, I've done 4 live events. In 3 weeks, it'll be our 6th. So it'll be our 6th annual. And it's the same kind of agenda. I interview women that are investors. They teach breakout sessions. It's awesome. And last year, so the first 3 years, the theme was overcome fear. Last year's theme was think bigger. And this year's theme is buy the block. You can see I said last year, if you're still here and have fear, like, don't come next year because we're moving on. We're leaving you behind.
I love it.
And so last year I said, stand up. Every year I ask people if you were a current investor to stand up. And, the first year there were 6 people. And then the second year there were 15 people. Well, last year I said, stand up if you've invested with someone in the room. And over 50 women stood up. They're investing with each other. And the reason is it's we cap it at 250. Like I've bursted out of the hotel, but I stay at this hotel because I don't want it to go to 300 or 400. I like the intimacy of the 2 to 250 because they see each other year after year. They stay connected, and then someone gets a deal. They raise money. They reach out to this group. It's phenomenal. But I realized that if I want to get that 3% to either 10 or 30, originally it was 10. And then last year when it was think bigger, I said 30. I don't know. I think I was drinking. So I said, I can't do that if I cap the audience of the conference. And that's when the podcast was born. I said, you know what? I can interview a woman a week. Every week, I'm going to interview a woman live, and then all the people that will stay on my YouTube page, and the women cannot say any longer they don't know any women doing it. Like I told you before we got on, we're close to 200 episodes.
Yeah.
So that's 200 women on the podcast and 8 times over 50 women at the conference. So that's why you're here. So welcome. And I can't wait to hear your story and share your story with the audience.
Yeah, and I'm so glad you're doing this, Beth. Honestly, it's near and dear to my heart because women investors, they're when I started, especially, very much like you, there were not a lot of us. There really weren't, and so I'm super happy that you're doing this. So thank you, and thank you for having me on.
I'm so happy you're here. So let's go back. So I've been investing since '92. When did you start?
Yeah, I started 30 years ago. May 8th of this year, 2026, will be my 30-year anniversary. Wow. I have that date specific in my head. So yeah, it's been since 1996 that I started.
Congratulations. And what was it that you invested in? Tell me how that came about.
Yeah, so my story is a little different than probably most. I did not choose real estate. Real estate actually chose me. I cut my teeth in real estate investing by inheritance. My grandmother unfortunately passed away, and my family inherited assets that were located in both California and Arizona. And the Arizona assets included 38 townhome units that were broken down. There were only about 40% occupied. The other 60% was either uninhabitable or in some version of disrepair. I also had a sewer treatment plant. I know a lot about sewer treatment plants, probably more than I want to, which I had absolutely no idea how to run, because when I started, I was 26.
Wow.
And then some land. The Arizona assets included land. So I went off to Arizona by myself, away from my family, having lost my father 10 months before and my grandmother on May 8th. Oh. And I didn't know anything at all about real estate or real estate investing. And by the way, the assets that we had, both California and Arizona, were about $4 million in debt. Okay. Oh. So, yeah. So, and keep in mind, everybody, nowadays we have live streaming, right? We're doing this right now. We have Google. But back then, Beth, right, as you know, there was no Google. I mean, the internet was barely existent.
We had maps. We had literally maps.
Digital maps, right? And so we had to open our mouths and ask questions. And I got pretty good at that, So off I go to Arizona. I was really young. I had no idea what I was doing. And I didn't know it at the time, but at the time I had a very high risk tolerance, because again, I didn't know what I was doing. And I had nothing to lose at that point. I really didn't. So I started with the 38 townhome units. And I was able to navigate by asking questions and surrounding myself with people that had the answers. I was able to navigate fixing those up and getting them 100% occupied within 18 months.
Wow.
Which is pretty phenomenal.
Yeah.
Yeah. I then negotiated the sale of the sewer treatment plant to the local district. And so they took over the sewer treatment plant. I negotiated that deal. Again, I was pretty new to real estate investing at that time, but we cut a pretty good deal and it sustained us, which was great. And then, again,
I have a question. Yes. So did you have family at home thinking, what is she doing and how is she going to do this? And oh my God, she's doing it.
Yeah. So my mom and my sister were handling the California assets. And I was handling the Arizona assets. And so we kind of were collaborating and constantly checking with each other to see how things were going. But, I was very fortunate in that I figured out really quickly that I had a head for real estate. And so my mother got to a point where she's like, just do what you feel is right. So I was very lucky in that regard.
Right.
Yeah.
Amazing. How did you fill the vacant units? And did you fix up the ones that were not in good shape and lease them too?
Yes, I had to, because again, most of them were uninhabitable. So I had to learn how to negotiate with contractors. I had to learn how to negotiate with vendors, because again, we were $4 million in debt. So I had to, and no one's going to give you basically a line of credit unless you do what you say you're going to do. So I had to leverage certain pieces to be able to get those units fixed and then occupied. And that's exactly what I did. I did exactly what I said.
Did you have capital? Did you go to Arizona with some access to capital so you could fix them up?
Not much at all. We had a little bit from the estate. But I had, like I said, I had to go to everybody we owed money to, and I had to ask them for references. Because, as rents were coming in, I just leveraged those rents to be able to expand my line of credit. And I paid people systematically monthly to expand the lines of credit, and the vendors worked with me. And literally within 18 months, we were 100% occupied. Within 24 months, we were back in the black completely. So I was able to pay off that $4 million in debt between the California and the Arizona assets. My family and I worked together, and we got really aggressive, and we were able to put everything back in the black in 24 months. So it was a stressful time. There was a lot of work.
So you were 26 when you took this on. What had you been doing? Like be from 20 to 26. Were you working? Were you in school? What were you doing that you just dropped everything and moved to Arizona?
Yes. I had been living in Florida for about 3 years in my early 20s. And I was working, my father was a dentist. And I was actually working as an office manager in a dental office, a large dental collaborative practice back in Florida. And when my father passed away 10 months prior to my grandmother passing away, I had realized Florida was not for me, and I came home to California. And I was helping my mother largely navigate my father had a lot of medical stuff. So I was helping my mother kind of to navigate through all of that when my grandmother passed away. So yeah, I just.
So it was you and your sister and your mother were the three musketeers and said, we're going to take this on.
Correct.
Amazing.
Correct.
Amazing. So you obviously stayed in the business. And
I
did your sister stay in the business?
Well, what happened was I realized, even though we were 100% occupied in the townhome units, I realized that we were not, because it was kind of a boutique market in Arizona. I realized for the long term, we were not going to be able to sustain profitability to command the market rents that we needed to sustain that profitability. So I went to my family and I said, listen, I want to sell these units off individually. And then because they were townhomes, and I said, and I want to use that money and build on the land. And my family said, we don't want any part of that. So I bought the company from them.
Wow.
And what I did was I leveraged the sales of those individual townhome units to pay the note, that I owed my mom. To buy the company. And in the meantime, I was also using part of that money to leverage building on the land. So
what did you want to build? How many acres was the land?
It was about 2.5 acres, and I was building a 25-unit townhome complex that was attached to the original 38 units.
Got it.
But I re-subdivided it. I changed the footprint of it completely. I got very lucky because the infrastructure was in. So all the entitlements had been done. All of the sewer lines were in, and, it didn't need to be updated. So I got really lucky that the infrastructure was in. I just needed to come up out of the ground. So, yeah. So I bought the company.
You're a 28-year-old developer in 1990.
At this point, we were approaching 2000. So we were... Okay. Yeah.
But still, I mean, a 28-year-old female developer, crazy.
Yeah, it gets better, believe it or not.
Okay. All right, good. I'm on the journey. So do you still own the real? Okay.
No.
So what happened next?
So I hired a contractor. I negotiated the sale of the company to me, with my family. We got that done. I got a loan from a hard money lender initially. I know. And then I hired a contractor and an architect, and I designed this project.
Why did you go to a HML instead of like a community bank? Because you were 28 and had no assets.
I was completely unproven.
Right. You remember the interest rate you paid the hard money lender?
I think at the time, it wasn't too bad at the time. I think it was about 9.5 to 10%.
Oh, yeah. Piece of cake. Okay.
It wasn't too bad. It could have been a whole lot worse, but it wasn't.
Right.
Yeah.
Okay. So go ahead.
So I hired the contractor. We designed I designed the project, hired the contractor, realized very quickly that he was going to bankrupt me before I was completely out of the ground. And so I fired him and I started my own construction company, and I knew nothing about construction, nothing at all. But again,
lady, you've got some cojones. Do you know what that means in Miami?
I sure do.
Okay.
Yeah, I do. But again, I figured out I was really good at this real estate thing. I had a head for it. And I just asked a ton of questions, and yeah, I was, don't get me wrong, there was fear there, but I kind of took on that I really wanted this for my family too. Even though I had bought the company from my family, I wanted to be able to protect my mom and my sister, to myself and my future family. I wanted to make sure that I had a future.
Was your sister older than you or younger than you?
Younger. Yep.
All right. So you now are going to become your own GC. So did you go get licensed?
Yes. So what I did is I was very smart about this. My corporation was the entity that held all of our licenses. So we literally got every license for building, commercial and residential, except HVAC and roofing. And the only reason I didn't go for those is because the general liability insurance was extraordinarly high. But I had everything else. I had all of our other licenses, and then I brought in a qualifying party. So I hired on a contractor that was already a licensed GC to be my qualifying party for the company. And that worked beautifully, because I figured if I ever needed to replace that contractor, I could without skipping a beat. And I did have to do that one time. So, we were building and growing really fast. Keep in mind that, all of this is from 2000 to 2005, 2006, 2007. So, within 3 years, I had 36 employees. We were building, commercial projects, other people's projects, my own projects, really high-end single-family residences. We were building smart homes before anybody knew what that was. That's what we were doing. So, and I was building an empire. I basically had more work than I could handle. And Beth, you remember the days, when people in between 2002 and 2006, if you had a pulse, you got a loan, right?
Yep.
So, I had way more work than I could ever handle. I was very fortunate that I invested my money wisely. I bought millions of dollars worth of construction equipment. I bought I invested in other people's self-storage facilities, other cash flowing assets, single family residences, and I was liquid and I wasn't leveraged. I only had about 10% of debt in my company, which was great. But
wait.
Yeah.
So you're running this company, you're building all of these different assets in different asset classes.
Yep.
You've got a big team.
Yep.
But then you said, and then I started investing. So how did you choose when you said, and I invested like in someone's self-storage deal? How did that come to you? Was it a guy or a girl? I can probably guess that. And did you invest as an LP? Tell me about the self-storage investment.
Okay. And the details, because again, this was,
I know, a long time ago. Yeah, whatever you can remember. I'm sure it was a guy, right?
Yeah. So that was actually because I was in a local community, and it's a boutique market in an area that's highly recreational, and so self-storage was always at a premium. And I didn't know what I was doing. I mean, there was it was almost to the point of a handshake deal. Thankfully, it wasn't. I did put things on paper, but it wasn't your standard what you would do today. It's certainly not anything I would do today. But it was it was quite lucrative. There were, I had friends that were local there. They had run other self-storage facilities, and so they were keeping up with the demand as well and building more. So we were building their projects as well.
Oh, okay, great.
I was also monetarily investing in them.
Okay, great. So you're building them, you're putting an equity in their deals, and you can see, because you're building them, the demand that was there. Okay, great. Correct. So you've got this company, you're doing a lot of building, you're investing your money, which is awesome. Yep. And you have low debt in the company. Yep. Okay, keep going. This is fascinating.
Well, the thing is, though, the trade-off, because all of this sounds really great, right? But the trade-off was that I was working 18 hours a day, 7 days a week. There was no stopping. The stress level was off the chart. And it literally was physically killing me. I was starting to have, at a young age, I was starting to have some health problems because the stress was enormous. And then 2007, 2008 came. And when the crash happened, I had a choice that I had to make. I could either declare bankruptcy like everybody else,
right,
or I could sell everything that I owned for pennies, literal pennies on the dollar, and pay off the people that I owed money to. I chose door number 2. So I fire saled everything I owned. I paid off everybody that I owed money to. And I do not regret that decision at all. But that choice came with a heavy, heavy price. I walked out of the crash having lost over $20 million.
Paige. That's breaking my heart.
Don't, honestly, I know that sounds, and I don't mean to be cavalier because that's a huge amount of money. And I spent a decade building that empire. But as difficult as that learning experience was, I would not change it for the world. It hurt. At the same time, I learned who I am as an investor. I learned how I deal with money. I learned my risk tolerances. And all of that has guided my path when I came back into real estate about assets that I specifically target, because I am now where I had a very high risk tolerance at 26. I'm now risk averse, right? I'm 30 years later. I have that experience taught me so much about myself and about this, how many different shiny objects there are out there, because there's lots of them, and who I am as an investor. And that's a really key piece for anybody looking to invest. Absolutely. If you don't know who you are as an investor, how can you possibly put your $100,000+ or $50,000 or 20, whatever the number is? Right. How can you put that anywhere if you don't know at least some semblance of what your risk tolerance looks like and who you are as an investor? So I would not change that for the world. And because of it, I invest mostly, I strategically invest in two lanes. One is distressed mortgage notes, because it's always good to be the bank. And the other is self-storage facilities that myself and my fund and my investors buy across the country.
Amazing. Okay, great. So how long after you did all your workouts and paid people back, did you take some time off and then come back in? So how long was that period?
It was about 3 years. It took me about 3 years to kind of clean up the mess, pay everybody off, because, again, I was trying to negotiate deals with cash was king back in those days. Anybody who had cash.
And what obviously a terrible situation, but a fabulous experience where you learned all about that.
Yeah. It really honed my skills in the art of negotiation. And I like to create win-win situations for everybody. I like to be fair because I've been through the unfair side of it. There wasn't a lot of leverage for me as a seller at the time, trying to sell my assets that I'd worked so hard for more than pennies on a dollar. I got lucky with a few, but for the most part, it was bare bones minimum. And I got lucky that I could pay everybody off that I owed money to. There were millions that were owed to me as a construction company, because in construction, we foot the bill for 90 to 120 days.
Right.
And my projects, I was running 5 projects a week at any given time. And each project was running payroll at $25,000 a week. So the money was extraordinary that was left on the table that I, unfortunately, people didn't pay me. So,
right.
Yeah. But I felt really good about being able to pay everybody.
Absolutely. What a testament to your character and integrity. I mean, because we all know people that didn't do that, right?
Yes.
So, okay. So now 3 years later, you're saying, okay, I think I'm going to dip my toe back in.
Yeah.
And I'm going to do it a little differently. But it really, truly, we gave a shopping center back to our lender during the everyone suffered. So it was we all could say it happened to all of us. It was the market. It didn't mean that we are lesser than, right? That we are still capable, and there's still a real estate market, right? So, but did you go back into construction, home building, development? Okay, so what? I'm not doing that again. So
No.
Tell me about that.
Yeah, because I mean, obviously I had nothing. I had to rebuild my capital, and I knew I could do it because I did it before. Remember, I started 4 million in the hole. So I thought, all right, you've got to be smarter about this. And so I sat down and I had a meeting with myself. I'm like, okay, how are we going to do this? How do you want to scale? What are your thoughts? And I literally kind of penciled down a sketch of what I was going to do. And like anybody else, I came back in. I did a little bit of wholesaling because I had to put a few bucks in my pocket, save a little bit of money. Then I graduated into the natural progression of things, which was fixing and flipping. And I started having Vietnam flashbacks of my construction days. And I thought, this is not for me. I really don't want to be doing this because I love taking ugly things and making them pretty. But for me, the middle stuff, I don't like to rely on other people for my profitability. So that was really key. And I thought, all right, I'm going to start researching things that I don't have to rely on other people mostly, because real estate is a team sport. Everybody, you have to have a team. I mean, not internally, but you have to create the atmosphere of the team around you, whether that's people you're investing with, your education support, mentors, accountability partners, whatever that looks like. It is definitely a team sport. And so I thought I need to find out what is going to suit me, where I'm not largely dependent on a market cycle or somebody else for my profitability. And that landed me in mortgage notes. Because again, it's good to be the bank. There's 23 different exit strategies plus exit strategies possible in note investing. And if you don't know what note investing is, I don't.
No, I don't. Tell me. I swear I don't know.
Fair enough. Okay. So when you invest in notes, whenever somebody buys a house or a commercial building or whatever, and you take a loan from the bank to buy said property, you sign a promissory note, which is basically your promise to pay the bank back at over X amount of years at a certain interest rate, et cetera. Then you're also going to sign, as you know, when you're sitting at the escrow table, you're signing an inch thick, wad of papers. In there is also either a deed of trust or a mortgage. Those are basically the same document, but it depends if you're in a judicial versus non-judicial foreclosure state. So if you're in a non-judicial foreclosure state, you're going to be signing a deed of trust. If you're in a judicial foreclosure state, you're going to be signing a mortgage. And that document ties the collateral, which is the house or the building, to your promise to pay. So if you stop paying, the bank is going to take back that property as payment for what you owe, right? Yep. So that's what I do. I step into the shoes of the bank. I will buy the debt that is secured by the real estate.
So do the banks look for, I mean, certainly I know that, when I used to have a mortgage on my house, it seemed like all of the time the mortgage kept getting sold, but it wasn't to people, it was to institutions.
Yes.
So are you buying shares of institutions that are buying mortgages, or are the banks saying, hey, Paige, do you want to buy this note from us? Yes. And you're a person and you own, because I've heard crazy stories, like, you watch movies where the guy steals the girl's boyfriend, the guy steals the girl from the guy, and then that rich guy goes and buys the guy's mortgage and then forecloses them.
something like that, but it's not shady.
So seriously, there are regular people that buy mortgages from banks.
Correct.
I
Now, keep in mind, you're not going to walk into Chase or Wells Fargo and say, I want to buy notes. They're going to, first of all, the branches they don't have any idea that this happens. It's all done at the corporate level. And even myself, even after as many years as I've been doing this, I'm not large enough to walk into a Wells Fargo tape. That's what it's called. It's a tape of assets, which is basically just a grouping of assets that they're going to sell.
Well, how did you get started? How did you even know this? I didn't even know this happened. Like, how did you, is it smaller banks that are doing this?
Yes. So small banks.
How did you even know? But you are now 32 years old.
Yes. When I came back into real estate, like I said, I started going to meetups, different RIA meetings and meetups and stuff like that. And one gentleman stood up and said, I invest in distressed mortgage notes. So what that means, and I do this as well, I buy non-performing notes, which means that the borrower has stopped paying. And the reason that I do that is because I buy that note at a discount, thereby mitigating risk because I'm building in automatic equity. Okay. But he stood up and he said, this is what I do. And it's basically you become somebody's bank. And I thought, okay, that checks a lot of my boxes, right? I'm not going to be reliant on somebody else for the outcome of my profitability. It's not market dependent because what is owed is what is owed. Now, there are pieces that come into play in terms of market valuations, but I try very hard to work with my borrowers to give them a second chance and get them to reperform. And because I buy these assets at a discount, I have some room to do that, right? So, and most people don't care what the value of their home is. If they've been there 20 years and they raised their kids in their home, they want to save their home, because people stop paying doesn't mean that they're bad people. They just have fallen on hard times. And if anybody knows about that, it's me.
Right. So how many do you think you bought? Do you remember how many you bought the first year or the first 3 years? Like, was this a thing? Was this the main thing you were doing?
I was paralleling. So I was still fixing and flipping because that was giving me some money. And then I was educating myself and dipping a toe in the note space. So
how do you remember the first one you did? How much it was?
Yes. I actually bought a handful of notes with an investor, by the way, a private investor. I got some private money, put my own money in as well. And my sweat equity. And it was a mini pool, which is 5 notes. And we spent $175,000 and we made an absolute killing on those assets. High double-digit returns plus. Now,
did you foreclose on the people or you just made deals with the people?
About a third ended up in a foreclosure because not everybody, even if you make those overtures, you're not going to get everybody else to, everybody to come to the table to want to stay. So about a third ended up in a foreclosure situation where we sold them, or the asset came back to us as an REO and I sold that house. One of which I liked a lot in Memphis, Tennessee, and I actually just put a renter in there and I just cash flowed it. It was great. And then a third will end up either in what's called a deed in lieu or a short sale, which means that the borrower will say, okay, I don't want to stay here, but I don't want a foreclosure on my credit. I'm willing to give you a deed in lieu of foreclosure. So you just take my house over. I'll just waive all of my rights to this house. Everybody knows what a short sale is. Yeah. And then a third I got to reperform. So I actually got 2 out of that 5 to reperform. And one was an REO that we ended up with that I put a renter in. Another one was an REO that we just sold. And then the 5th one was a short sale. So,
okay. So what are you doing now?
Yeah, I know, it's crazy. So I still do mortgage notes. Now things are very different now. When I first started doing mortgage notes, well over a decade ago, I was buying it between 32 and 38 cents on the dollar. But things are different. Nowadays, pricing, we've got a lot of overinflated values on both commercial properties and also homes, residential homes. So it's been a little tough for the last couple of years in terms of buying anything with regularity in the mortgage note space, which is why I have the second lane, which is self-storage facilities. So, and because I love the model, no matter what the market cycle is doing, Americans don't get rid of their stuff. We hold on to our stuff, and we outgrow houses and garages, and we need bigger, we need places to put things. And so I am happy to provide those little metal boxes that are very resistant to termites, that don't need granite countertops and fancy bathrooms, that just cash flow. So those are my two main lanes that I invest in because I am very risk averse.
And do you raise money for people to invest with you, like in syndication? So tell us about the Tryllion Group.
Yes. So the Tryllion.
And I want to know how CashflowChick came up.
Fair enough. I was actually in a mastermind about growth and scale, and branding became a really central topic. And so CashflowChick came out of that. And I struggled initially with the name, to be honest, Beth, because it was one of those things that I'm like, well, I'm not really a chick. And a friend of mine said, you know what, Paige, you have a complete platform, an open-ended platform to redefine what that means. And I thought, I really like that. And so men absolutely love it. Women, they either love it or hate it, but it's memorable. Right. So,
I'm the canvassing queen.
Yeah.
Red and the canvassing queen. So I'm all about the monikers.
Absolutely. Yeah. So CashflowChick is the brand. I started using that to actually teach people about notes, believe it or not. I had a lot of investors that came to me that said, before they became investors, they came to me and said, I love the concept. I want to know what you're doing. How can we learn how to do this? And I thought, well, let me put a program together. So initially it started out live teaching, 2 days over a weekend. Then it extended. It's too much information because I give it all. If I'm going to teach somebody how to fish, I'm going to give you all of the tools. Right. I'm not going to hold anything back because it's my passion that people are successful. It really is, because I started from nothing. And if I can do it, anybody can do it. So I'm really passionate about, if I'm going to teach somebody, I'm going to give you all the tools. Right. So I used CashflowChick to build that brand and teach people. I created a workshop. When COVID hit, it went virtual. Now it's just on demand online. So anybody can learn. And it's
how do people find it?
buildingwealthwithnotes.com, buildingwealthwithnotes.com, or you can go to cashflowchick.com and there's a little tab that says training.
Okay, great.
Yeah. So, I give you all the tools, and I loved it. I have students that have been able to quit their W-2 jobs because they've invested in notes. And it's just, I'm very passionate about people not necessarily being reliant. Not being reliant on someone or something for their livelihood, because I know what it feels like to literally lose everything. And I got lucky because I invested wisely. And
you were reborn. So tell us about Tryllion Group.
Yeah, so the Tryllion Group is a fund. When I came back in, I started using private investors. I started doing JV partnerships, and that grew very quickly. And I got to the point that it made more sense for me to start a fund, which is the Tryllion Group, such that I can have greater buying power for both mortgage notes and self-storage facilities. protect my investors because there's risk mitigation in numbers, right? Strength in numbers. And it allows us to pivot as well. So those were the three things that I really was very important to me when I started the fund. We initially were a 506B. We have now gone to C. So we are accredited investors only.
Okay. And then how big is the fund?
The fund, this round, we're raising up to 12 million in capital. We do have a pref return and and an equity split. So if anybody's interested in that, please reach out. More than happy to talk with you about that and send you the deck, et cetera. Yeah.
Awesome. That's amazing.
Yeah.
Okay. So we have usually a few hundred people that watch us live, and then a lot of replays on the episodes. And I would say that 50% of the viewers have capital, but they haven't dipped their toe in.
Okay.
For a myriad of reasons, right? Fear, uncertainty, you name it. So what would be your one piece of advice for those people that maybe they have like a couple 100,000. We're not talking about people that have millions, right? They have maybe they can self-direct their IRA and they've got 200 to 250 to invest, but they're just not sure where to start. What is your advice?
Okay. I have a couple different pieces. Number one, fear, because fear is a big one. I get that a lot. And I even sometimes now I will, that little voice in your head that says, what are you doing? Why are you doing that? Right? Fear, you have to remember, it is literally false evidence appearing real. And I've named my little voice. I call my voice Lucy, and I tell Lucy, thank you very much for your input. I'm going to bless you and release you because you're lying to me. So I let that go. Also keep in mind, everybody, we've all had our storms, right? We've all had trials and tribulations. And I want to remind you, because I had a mentor say this to me. If you are sitting here today, you have literally survived 100% of the storms and trials that you have faced and gone through. 100%. So your success rate is 100%. Give yourself that credit, even though you might have that voice in your head. And once you do that, sit down with yourself, like I did, and figure out, who am I as an investor? Because there's so many different avenues of investment, so many different risk levels of investment. For me, slow and steady wins the race. I might not be the sexiest in my investing strategy. It might not be the fastest in my investment strategy, but slow and steady wins the race for me. And that's great for me as an investor because my risk tolerance is very low. If you have a higher risk tolerance, great. Look at things that are going to afford you of what you're seeking, what your goal is, what your risk tolerance is, and who you are as an investor. Okay. So there's certain things that I don't invest in. There's certain things that don't suit me and my money structure. And that's something that is very personal and very individual. And you need to have that meeting with yourself first before you start looking into investments. And the last piece is education. You have to know enough about the investment to be dangerous. You don't have to know everything because I don't even know everything. I'm sure, Beth, you attest to the fact that you don't know everything. I'm still learning after 30 years of doing this day in and day out. Yeah. So don't let that be your stop, right? Don't think I have to know everything. Know enough that you can ask the right questions and be dangerous enough to feel secure that that's where you're putting your money and you're comfortable with that. Those are my pieces of advice.
Excellent. Excellent. Paige, thank you so much. What a great story. Congratulations for losing 20 million and then turning it back around and learning the lessons and rising from the ashes. So bravo, CashflowChick. Thank you for being with us. And what's the best way for people to find you? Would it just be to look up CashflowChick?
Yes, you can even book a call directly on my calendar. If you go to askcashflowchick.com, you can book a call immediately on my calendar. I'd love to talk with you, even answer any questions. Again, the real estate is a team sport, and I'm really open to collaboration. So I would love to speak with you. Or you can go to thetrilliongroup.com, the Trillion Group. Make sure it's thetrilliongroup.com. But easiest to book is to book a call directly with me at askcashflowchick.com.
All right. Well, we've got lots of places you all can reach out to. Paige, thank you so much for being here and being a guest on Women Investor Wednesdays. Have a great night.
Thanks. You too, Beth.